Few people truly comprehend how the contemporary banking system operates. They have a mental model of how banks receive deposits from customers and then lend those deposits as loans that they picked up from textbooks. In reality, banks borrow money from other banks to pay for their loans. This is Businessville, and if you find today's video to add value, give it a like, share it with your gang, and subscribe to the channel. A bank will borrow money in the interbank market at a slightly lower rate after agreeing to make a loan. Prior to borrowing to pay for the loan, there must be ending. The reason why so many loans are tied to LIBOR is because banks set their interest rates at levels that are occasionally higher than what the banks pay to borrow money. When the government borrows and spends, there is a similar misconception. People believe that in order to have money to spend, the government must first collect taxes or borrow money. In reality, the government simply spends as much as it wants and then levies taxes to offset the impact of that spending on the money supply. Simply put, banks fund last and lend first. Spending comes before funding in the government. What is bank failure? A bank failure occurs when a federal or state regulator closes an insolvent bank. State-chartered banks may be shut down by banking commissioners or by the federal government, respectively. When banks are unable to fulfill their obligations to depositors and others, they may be forced to close. The insured portion of a depositor's balance, including funds in money market accounts, is covered by the Federal Deposit Insurance Corporation in the event that a bank fails. Understanding bank failures. When a bank is unable to pay its debts to depositors and creditors, it fails. This could happen if the bank is no longer solvent or does not have access to enough liquid assets to meet its obligations. The most frequent reason for bank failure is when the asset value drops below the market value of the bank's liabilities, which are its debts to depositors and creditors. This might occur as a result of excessive investment losses by the bank. When a bank will fail is not always predictable. What happens when a bank fails? In order to repay its depositors when a bank fails, it might try to borrow money from other healthy banks. Depositors may rush the bank in an effort to recover their funds if the failing bank is unable to pay its depositors. As depositors withdraw cash, this could make matters worse for the failing bank by reducing its liquid assets. The federal government has insured bank deposits up to $250,000 in the United States since the FDIC was established. When a bank fails, the FDIC assumes control and either sells the failing institution to a more financially sound institution or takes over management of the institution. Depositors with money in the failed bank will frequently continue to have the same banking experience. They can still use their debit cards and checks and still have access to their money. Examples of bank failures. In the midst of the 2008 financial crisis, Washington Mutual, a bank with $307 billion in assets, closed, becoming the largest bank failure in American history. In addition to a weak housing market and a run on deposits, Washington Mutual struggled for a number of reasons. J.P. Morgan Chase eventually paid $1.9 billion to acquire WaMu. The closure of Silicon Valley Bank in 2023, following a bank run in which customers withdrew $42 million in less than 48 hours, was the second largest bank failure in the United States. At that time, the bank's assets totaled $209 million. Prior to and during the Great Depression, when thousands of banks failed, bank failures were frequent. When the FDIC was established in 1933, American depositors had already suffered significant financial losses as a result of bank failures. They had no way to get their money back if the federal deposit insurance that protected these deposits wasn't in place. Protections against bank failures. In an effort to lower the risk of failure, the Federal Reserve now typically mandates that banks maintain a certain amount of cash reserves on hand. A percentage of the deposits it holds make up the reserve amount. Normally, A bank must hold more than 10% of its liabilities in cash reserves. But due to the COVID-19 pandemic, this requirement was suspended in 2020 and hadn't been reinstated as of March 2023. Consider only keeping up to the FDIC insured limit, or $250,000, in a bank account to better safeguard yourself against losing money in the event that bank fails. For the same FDIC protection, you can open another account at a different bank if you need to deposit more money, despite the fact that they are not as frequent as they were in the years preceding and leading up to the Great Depression. Even though there are rules governing the amount of cash reserves that banks must keep on hand, and the FDIC insures a portion of the deposits, bank failures still occur. A bank failure can be brought on by a variety of factors, such as a sudden run on deposits or shifting economic conditions. What are your thoughts? Let us know in the comments. If you found the video to be informative, don't forget to like, share, and subscribe. Thanks for watching.